It just doesn't fit. I've been staring at these warehouse receipts for the better part of the morning, specifically the turnover from late January into the first few days of February, and the math isn't reconciling with the price action. Not even close. Usually, when you see a price collapse like we just saw, that 10–11% air pocket down to $75, the narrative writes itself. You assume demand evaporated. You assume the speculators got spooked, liquidation, margin calls, everyone heading for the exit at the same time. And usually, when everyone sells, the metal just sits there. It piles up. Nobody wants it. That's what a crash looks like. But look at the vaults. 34 million ounces. That's what left. That's not paper trading volume. That's not a derivative shifting hands. That is 34 million ounces of physical silver removed from Comex deliverable categories in basically 7 days. Gone. I checked the historicals going back to March 2025, and, well, we haven't seen a drawdown velocity like this since the squeeze started. And the timing is what makes me uncomfortable. It's too perfect. See, you have the price on your screen flashing red, screaming panic, telling you the asset is worth 10% less than it was last week. But the logistical reality, the trucks leaving the depository, is screaming that there isn't enough to go around. Those two things are diametrically opposed. They cannot both be true in a free market. One of them is a lie. And I think most people are looking at the wrong number. They're fixated on the $75 spot price because it hurts to look at. It's visceral. It impacts the portfolio balance immediately. But while everyone was staring at that red candle, distracted by the margin hike news coming out of the CME, someone walked in the back door and cleared out 22% of the available float in a week. That's not panic selling. That's a raid. I want to walk you through the ledger entries, not the headlines, but the actual daily warehouse reports from the last few days, because there's a signal buried in the registered category, specifically regarding which entities are taking delivery, that changes the entire context of this crash. It suggests that this wasn't a liquidation. It looks more like a transfer of ownership at a forced discount. And if you're holding paper contracts right now thinking you're exposed to silver, you might want to sit down for this, because the metal you think you own might have been on one of those pallets that just left the building. Let me show you what I found in the Tuesday data. The Tuesday report is where the anomaly stops being a glitch and starts looking like a strategy. If you pull up the daily warehouse stock movement, not the summary, but the line item activity per depository, you see a specific pattern of withdrawals. We aren't talking about a gradual bleed here. We're talking about 34 million ounces vanishing in a window that perfectly aligns with the price destruction. To understand why this is terrifying, you have to understand who just got hurt. On February 2nd, the CME Group, the entity that runs the exchange, changed the rules of the game. They hiked the margin requirements for silver futures from 11% to 15%. Now, if you're not a futures trader, let me explain what that actually means in one sentence. It means that overnight, every speculator holding a contract on borrowed money had to come up with millions of dollars in fresh cash just to keep their position open. Most couldn't, so they were forced to sell. That is what you saw on the chart. That vertical red line that took us down to $75 wasn't market sentiment. It wasn't that the world suddenly decided solar panels don't need silver anymore. It was a liquidity flush. It was a forced liquidation of paper contracts held by people who didn't have the cash to meet the new margin rules. That part is normal. Markets flush leverage all the time. But here is the contradiction that keeps me up at night. Usually, when you have a liquidation event like this, the physical inventory stays in the vault. The paper changes hands. Trader A sells to Trader B, but the bar of silver sits on the shelf collecting dust. This time, the bars left. Look at the slope of that decline. While the paper price was crashing because traders were broke, someone with an immense amount of liquidity stepped in and removed 34 million ounces of physical metal. Do you see the divergence? The price says silver is unwanted, the inventory says silver is being devoured. And this brings us to the most misunderstood terms in this entire market: registered and illegible. I promise I won't bore you with the handbook definitions, but if you don't get this, you are flying blind. Illegible silver is just metal sitting in a Comex-approved warehouse. It's like storing your car in a parking garage. It's there, but it's not for sale. Registered silver is metal that has a warrant attached to it. It is available for immediate delivery to settle a futures contract. The drain we just witnessed didn't just come from the private stash. We are seeing a bleed in the registered category that has pushed levels to lows we haven't seen since the March 2025 crisis. This means the buffer is gone. The metal that is actually available to settle these trades is disappearing at the exact moment the exchange is telling you the price is dropping. So, who is on the other side of this trade? Think about it. Who benefits when the price gets smashed to $75 right before they take delivery? Who has the capital to absorb 34 million ounces in a week without using leverage? It isn't the retail trader. It isn't the hedge fund trying to make a quarterly bonus. The entities taking this metal are industrial giants and sovereign wealth funds who know exactly what the deficit looks like for the next 5 years. They aren't trading the chart. They are securing the supply chain. They saw the margin hike coming, or maybe they just waited for it. And when the paper traders were forced to puke up their positions, these whales opened their mouths and swallowed the physical assets at a discount. This is where it stops making sense for the average investor. You look at your screen and you see silver minus 10%. You feel fear. You feel like you made a mistake. You want to sell to stop the pain. But if you could look inside the vault at the focused activity of the loading docks, you would see the exact opposite of fear. You would see urgency. You would see a scramble to secure every ounce that isn't nailed down before the market wakes up to the fact that the price is wrong. And the scary part? The price is wrong, because 34 million ounces just left the building at $75. If that metal doesn't come back, and it rarely does once it enters the industrial supply chain, then the Comex just got significantly more leveraged. The ratio of paper claims to actual deliverable ounces just skyrocketed. We are walking into a setup where the exchange has less metal to back up more contracts right after a margin hike that was supposed to stabilize the market. It didn't stabilize anything. It just transferred the asset from weak hands to strong hands. In a minute, I'm going to show you the mechanics of how they hide this flow using the exchange for physical mechanism. But first, you need to realize one thing about that $75 price tag. It wasn't a crash. It was a clearance sale, and the shelves are now empty. Here's the thing that trips people up. It's the mechanics of the heist. If I told you that someone went into the market and bought 34 million ounces of silver, your instinct would be to say, well, the price should have skyrocketed. Basic supply and demand, right? Massive buying pressure equals green candles. So why did we get red candles? Why did the price collapse while the metal was being bought? This is the mechanism that Wall Street doesn't like to talk about. It's the difference between the lit market, that's the screen you and I look at, and the private settlement market. See, if you or I want to buy silver, we hit buy on a platform. That order hits the order book. It adds pressure, it moves the needle. But when a sovereign entity or a massive industrial conglomerate wants to secure 34 million ounces, they don't just click buy on the open market. That would be suicide. It would blow the price out $10, $20 higher in seconds. They'd be bidding against themselves. Instead, they use a mechanism called exchange for physical, or EFP. Essentially, it's a private deal. They find a holder of a short position, usually a bullion bank, and they say, I will take your physical metal off your hands, and in exchange, we will settle these futures contracts off the exchange. This transaction happens in the dark. It doesn't print on the ticker tape in real time. It doesn't trigger the algorithms. So here is what actually happened last week. The CME hiked margins. That forced the small guys, the speculators, the hedge funds using leverage to sell their paper contracts on the lit market. That selling pressure drove the screen price down to $75. That was the smoke. While that public panic was driving the price down, the big boys used that lower benchmark to price their private EFP deals. They essentially waited for the fire sale, then walked over to the bank and said, okay, the spot price is now $75. I'll take the metal at that price. They used the liquidity of the crash to mask the acquisition of the asset. It is brilliant, it is ruthless, and it is completely legal. But it leaves a footprint, and that footprint is the empty vault. You can hide the transaction, but you cannot hide the delivery. Eventually, the daily warehouse report comes out and we see that the metal is gone. That is what we are looking at today. We are looking at the aftermath of a massive off-market transfer that was subsidized by retail panic. Now, I want to pause here. I want to be extremely careful because I don't want to sell you a fantasy. There is a scenario where I am wrong about this, and for your own risk management, you need to hear what that looks like. If we wake up next week or the week after and we see 30 million ounces suddenly reappear in the eligible category of the Comex warehouses, then this entire thesis dissolves. It happens. Sometimes metal isn't leaving the ecosystem, it's just moving pockets. It moves from JP Morgan vault to a Brinks vault, or it moves from registered back to illegible because the owner decides not to sell. If that inventory number bounces back up to 450 million by mid-February, then this wasn't a drain, it was just a shuffle, it was an accounting noise. And if that happens, the squeeze isn't here yet, and we are likely stuck in this trading range for another 6 months. I need you to watch that total inventory number like a hawk. If it refills, the signal is dead. But, and this is a big but, look at the leasing rates. This is a signal most people ignore because it's boring, it's obscure. If silver was truly plentiful, if there was plenty of supply just sloshing around, the cost to lease silver, essentially borrowing the metal, would be near zero. Why pay to borrow something that is everywhere? But lease rates are tightening. The curve is shifting. That tells me that inside the industry, behind closed doors, there is stress. Industrial users, the people making solar panels, the people making electronics, are having trouble sourcing 1,000-ounce bars. They are willing to pay a premium to get the metal now. That behavior doesn't align with a shuffle. That aligns with a shortage. So we are left with a split reality. On one side, you have the paper market, governed by margin mechanics and algorithms, telling you silver is a sell. On the other side, you have the physical market, governed by logistics and industrial need, screaming that they cannot get enough metal. Usually, these two realities can coexist for a long time. The paper market is so much bigger that it can bully the physical price for years. We've seen it happen. But there is a mathematical limit. The Comex works on a fractional reserve basis. They don't have a bar of silver for every paper contract. They have maybe 1 bar for every 20, 30, or 50 paper claims. That works fine as long as nobody asks for the metal. As long as traders are happy settling in cash, the game continues. But when 34 million ounces leave in a week, that leverage ratio spikes. The amount of physical backing the paper just got significantly thinner. We are approaching a binary outcome. There are really only 2 ways this plays out from here. Path 1, the price stays suppressed at these levels, $75 to $78. If that happens, the drain will accelerate. At $75, silver is too cheap for the industrial buyers to ignore. They will keep taking delivery. They will drain the registered stocks until the exchange is forced to declare a force majeure, basically admitting they don't have the metal to settle the contracts. That is a nuclear option. That is a system break. Path 2, the price has to rise to a level that kills the physical demand. The price has to go high enough that Samsung and Tesla and the solar manufacturers say, okay, that's too expensive, we will wait. To stop a drain of this magnitude, you can't just hike margins, you have to hike the price. We are standing at the edge of that decision. The market has to decide, does it break the exchange or does it reprice the asset? And right now, looking at the speed of these withdrawals, I don't think they have much time to decide. So where does this leave us? I know the question on everyone's mind. I see it in the comments, I hear it in the consultations. You want to know when. When does the math finally override the mechanism? When does the paper price snap back to reality? If you're looking for a date, you're going to get hurt. The market can remain irrational longer than you can remain solvent. We know the quote, but we need to update it for this specific situation. The exchange can change the rules longer than you can hold your position. We just saw them do it. They hiked margins. They can do it again. They can make them 20%, 30%. They can make it prohibitively expensive to be long silver on paper. They can force you out. This brings us to the scenario tree. I mapped this out not to predict the future, but to understand the exposure. There are really only two directions this travels over the next 6 weeks. Scenario A, the slow strangulation. In this version, the powers that be, the bullion banks, the exchange, managed to cap the price here at 75. They used the margin hikes to keep speculators out. The price looks weak. If this happens, the physical drain will continue, but it will go quiet. The 34 million ounces we just saw leave will be followed by another 10, then another 5. It becomes a slow bleed. The risk here is complacency. You look at the chart, it's boring, it's chopping sideways. You lose interest. You sell your stack to buy something that's moving, like tech stocks or crypto, and that is exactly when the vault goes empty. If we stay in this range, the registered inventory eventually hits a critical psychological floor. Let's call it 30 million ounces. At that point, the big industrial players panic, not because of price, but because of availability. If Samsung thinks they can't get silver for their chips next month, they don't buy some silver, they buy all of it. That is the run on the bank moment. It happens overnight. It doesn't give you a chance to re-enter. Scenario B, the cash settlement betrayal. This is the scenario nobody wants to talk about, but you have to know it exists. It is buried in the fine print of the Comex rulebook. If the inventory truly hits zero, if they cannot deliver the metal, they don't have to close the exchange. They don't have to declare bankruptcy. They can declare a cash settlement. That means if you are holding a futures contract that says you are owed 5,000 ounces of silver, they can simply say, "We don't have the silver. Here is the cash equivalent at the current spot price. Here is your check for $75 an ounce. Have a nice day." Meanwhile, in the real world, the physical metal is trading for $100, maybe $150 between private parties. You get your money back, but you don't get the upside. You miss the squeeze. You are left holding fiat currency that is rapidly devaluing, while the asset you thought you owned is unobtainable. This is why I constantly harp on the difference between exposure and possession. If you are holding an ETF that is unallocated, or a futures contract, or a digital token that tracks silver, you are betting that the system functions normally. You are betting that scenario B never happens. But looking at a 34 million ounce withdrawal in 7 days tells me that the system is not functioning normally. It is under extreme duress. So what is the playbook? I can tell you what I'm watching, and I can tell you what I am explicitly not doing. I am not trying to trade this leverage. I am not trying to guess the bottom of this dip to the penny. The volatility we saw on February 2nd, that 10% drop, is designed to wash out traders who try to time the market. It's a meat grinder. I am watching one specific metric, the daily registered stock at the Delaware Depository. Why Delaware? Because that is where a significant chunk of the recent movement originated. If we see another large block, say 5 million ounces, move from register to illegible or out the door completely, then we know the drain is systemic. It wasn't a one-off. If that number stabilizes, I will reassess. I will accept that the squeeze has been delayed. But until those vaults refill, my stance is unchanged. I am treating physical silver not as a trade, but as insurance. You don't trade your fire insurance. You don't sell it because you think the risk of fire went down 10% this week. You hold it because the house is made of wood and the neighbors are playing with matches. The financial system right now is made of wood. The margin debt, the leverage, the derivatives, it is all flammable. And this inventory drain, this disconnect between price and reality, that is a spark. I don't know if it catches fire tomorrow. I don't know if they can suppress it for another month. But I know that you cannot drain 34 million ounces every week forever. The math eventually hits zero. And when it does, the price on the screen becomes irrelevant. The only thing that will matter is what you can hold in your hand. We are entering a period where the official price is going to be a tool of deception, not a measure of value. Don't let the red candles fool you. Watch the metal. Follow the metal. It's leaving, and it's not coming back. I want to leave you with one question to consider before the markets open on Monday. If the price of silver is truly crashing because nobody wants it, why are the biggest vaults in the world emptying faster than they have in a decade? Think about that. I'll be tracking the Monday warehouse reports as soon as they drop. If we see another million-ounce withdrawal, we will know the raid is still on. Stay skeptical. Stay liquid. I'll talk to you soon. It just doesn't fit.